Welcome to Finding Proof, where we discuss all things early stage VC.
We're your hosts, the Nassus and Jenny of the Proof Fund, and our goal is to get to know the best seed and early stage VCs out there. Today, we're speaking with Dustin Rosen, managing partner at Wonder Ventures. He previously co-founded Pose, which he ran for multiple years, and has also served as an investor at LA-based venture capital firm, the Mailroom Fund, which is comprised of committed capital from Accel, Venrock, AT&T, and William Morris. Wonder Ventures is based in LA and strives to invest in the best founders at the earliest stages in Southern California. So Dustin, thanks so much for joining us. Our funds have had the privilege of working on a few deals together, and we're really looking forward to learning more about Wonder Ventures and your perspective as an investor. So tell us a little bit more about Wonder Ventures and your mission to invest earlier than anyone else in Southern California.
Thank you. And it's great to be here. And I've been working with Proof now for a few years, and it's been an awesome. For Wonder Ventures, as you said, investing earlier than anyone else, and we kind of add to that the best founders, which is obvious. I built my career here in Southern California as a founder originally for 5.5 years. And then when I started this fund about 6 years ago, after being a founder myself, it was clear that LA had this growing tech scene, growing group of people that were entrepreneurial, that wanted to start companies, build businesses here. But we just didn't have the financial infrastructure that the Bay Area had around venture capital. Mm-hmm. And I'd argue even New York as a second kind of investor finance related city. LA had entrepreneurs, but not traditional angel or early capital. And as I began investing, it was clear that the earliest stage was the biggest gap here in LA. Right. The IPOs that create that second generation of wealth, the angel investors were lacking. What we found is that the large VCs will come down here for Series A's all day, but the stage before that, the seed, or in my case, even the pre-seed, as it's now called, was really lacking. And so we built Wonder Ventures specifically to fill that gap.
How do you define pre-seed? I've heard so many different terms nowadays. It used to be angel, Series A, et cetera. And now I heard somebody even use the term soil stage.
There's all sorts of terms, and Genesis and soil and pre-seed, and it's pretty silly. I think it's actually just a nomenclature for trying to get earlier. Everyone wants to say they were the first in. But the way I look at it is my own experience. When I was a founder, we raised a seed round that was about $1 million on a $4 million valuation. And then we raised a Series A round that was a $3 million round on a $10 million valuation. If you know the current seed rounds in the Valley and most of the country right now, 3 on 10 is a seed round. First round capital, funds like that are doing those rounds. Pre-seed, 1 on 4 is what I do. It's just what seed was called 10 or 15 years ago. So it's really everyone's moved up the stack as seed funds have succeeded and become bigger. They've left this gap, and we're just filling that gap. Honestly, I never meant to call it pre-seed or otherwise. I'm glad it got a name because it helped me raise LP capital. But the truth is I just want to back great founders in their earliest and first round.
Right. And as a stage, is that pre-product?
So the pre, I think, is what really throws people off, because when you hear pre-seed, you think pre-product. The stage is really about check size, fund round size, and ownership. So yes, we will fund founders with a PowerPoint pre-everything, a beta pre-product, but we're also funding companies with small amounts of traction, a couple $1,000s a month in revenue, or early customers. It's really about the round size. I usually say it's rounds up to $1.5 million, maybe even touching 2 million now as things continue to get bigger, and valuations below 10 million post, ideally closer to 5.
And so what distinguishes a great founder in your mind versus a good founder?
Well, that's the hardest question. I think I still spend every day trying to figure that out. But a couple of traits we look for that we really value, as you will, the terminology founder market fit, right? Why is this founder starting this company at this time? As an early stage investor, surviving, pivoting, staying in business, staying true to your mission is one of the most important things to select for, because we're going to have a lot of companies that don't work out, and just getting multiple swings at the bat can be as valuable as anything. And so we really push these founders for why they're starting this company at this time. And we look to not fund founders that said, this is a good idea, and I thought about it for a month and I decided I could raise money. We
Right.
really want those people that are focused on a big market with a long vision for what they want to build. Obviously, execution is also key. Can they actually build what they say they can build? You might have a good idea, but if you can't actually produce software, produce product, that's tough. We're not
Yep.
afraid to fund non-technical founders, though. We've had some good success with that, but we have to believe that they can sell the vision, can recruit a team, and can kind of build on top of what they might not know.
Right.
And how do you get your deal flow at that stage of the market? Do you have to just constantly be talking to founders and all their friends who are looking to start businesses?
Yeah, we're constantly evolving what deal flow means. The good news, to be honest, is at this stage, and especially in our market, although it's always changing, it's not like a Series A where there's obvious traction and top 10 firms are all competing to win it. We're often funding teams that they're so excited to have our term sheet just to put them in business. But of course, it's about making sure we find them. And so we're building relationships at local universities. We're building a lot of relationships with the tech companies in town. So we want to know who are the next people to spin out of Snapchat or Hulu or Honey in LA, product and engineering and marketing and other, professionals. And so we build networks into those communities. But honestly, building our brand in LA so that someone wants to raise their first $750,000, they've got a couple angels, but they need a lead check. That's exactly what we're here to do. And so it's both inbound and outbound as far as deal flow.
And so you had mentioned that you previously founded a company, I believe it was called Pose, correct?
Yes.
Okay, awesome. And you served as its CEO for multiple years and raised multiple rounds and went through that experience. What sort of lessons did you learn from that you share with founders within your portfolio?
That was an amazing experience, basically over a year unpaid getting off the ground,
Mm-hmm.
raising a seed round, then an A round. We raised 3 rounds of venture capital, 35 employees at our height. We had over 10 million downloads of our applications in 2010 through 12 range. And with all that said, we ended up selling in an acqui-hire later in 2013, and it wasn't a huge outcome by any stretch of the imagination. And so I learned a lot about actually just building a team, running a company, the ups and the downs. And I joke to founders, my value add might be helping you learn all the things not to do. We
Right.
certainly made some
Which
mistakes.
is also very valuable.
It is.
Yeah.
We made some mistakes. One of the ones I talk about is in the first 6 months of the company, we were quote unquote stealth. So we'd raised a bit of money. We had some kind of unwarranted heat in the tech market in LA, but I wouldn't tell anyone really what we were doing because I thought it was so
Right.
unique. And to be honest, as soon as I told people, it quickly became clear it wasn't actually that feasible, what I was trying to build. And so being stealth basically cost me 6 months of learning I should have focused on something else. And it's really all about execution. And so lessons like that, I try to instill in our founders as we invest in them.
Do you focus on any specific market or are you pretty broad? How do you think about the verticals?
Yeah, because we are focused both geography and stage, that narrows down our pipe versus other investors. So, if I said any more specificity, it would limit probably too much. We want to be the best companies in LA horizontally, but we do have some areas we don't touch, biotech and hard sciences. We love software. So if it has hardware without a software component, it's going to be a tougher sell for us. We're not afraid of very consumer products. We've had our best exit in Honey with a consumer business, although we tend to shy away from consumer products. So something that's going to have inventory and a direct to consumer brand. But no, we don't over specialize in a theme. I like to say if I know what the next big thing was, I hope I already invested in it. Otherwise, I'm going to let the great founders tell me what the next big thing is.
So we recently spoke to Steve Marcus, who I know you know at Riot Ventures. So we talked a little bit about the LA market, but from your perspective, sitting at the ground level of company formation, give us a view of what's happening there now. We know that there's more and more companies and successes and all that, but how does it look at the ground floor?
Yeah, I think, as I said earlier, we're starting to see that second, third generations of talent coming out of other companies. We've funded teams out of Honey, out of ZipRecruiter, out of Headspace, people that have learned inside companies that have scaled and now are starting their own companies. And you're starting to see a multiplying effect in that here in LA. We are seeing an inbound group of talent. We've also funded founders from both New York and San Francisco move to LA, looking for a different lifestyle, looking for cheaper rents. There's a lot to like here, with especially from the Bay Area still being a 45-minute flight to the best VCs in the world, to your
Mhm.
big customers in enterprise software. So we're obviously very bullish. The pandemic has put a lot of question marks on all of this, but to be honest, I think the exodus from those two cities into LA has only grown. Although you also hear stories of people leaving LA to move to Nashville and Las Vegas
Right.
and even cheaper locales. So we'll see where that winds up post pandemic.
How has the pandemic actually shaped your investment philosophy currently and investments that you make?
Yeah, we have to think about it deeply because we're very susceptible to future rounds of funding being so
Right.
early. Our businesses won't tend to have profitability and things that can make
Mhm.
them more independent of future financing. And so we've scaled probably admittedly a little more barbell, either super early. So we've
Mhm.
written actually some smaller checks into 2, 3 person teams, usually deeply technical, who can build for the next year or two without real funding risk. They're basically just paying themselves a modest amount of living stipend and they're working on their product and we're
Mhm.
funding that. Or we've moved a little later. We're actually leading right now our largest round for a pre-seed fund, which is $2 million, meaning we want to make sure they have enough money to get to that next step and build the traction to get to that next round. I think there was a medium in between round that we know, oh, this company will definitely raise a seed round in 6 months, that we can't rely on in the pandemic given
Right.
fundraising changes. And so we've moved either super early or slightly later.
That makes a ton of sense. And you just launched a recent initiative during the pandemic as well called Wonder from Home. Can you tell us a little bit about that?
Yeah, Wonder from Home is definitely an example of the former I just spoke about, where
Mhm.
we end up funding 3 teams. We had spent March and April kind of working on our teams, triaging runway and making sure everyone was prepared for what was likely an economic downturn. And we came out of that and said, listen, we still have a fund. We still believe in our founders. We have seen deal flow slow down in the total aggregate, but the best companies and the top founders, the amount of companies we engage with hasn't really slowed down. It's just, I
Right.
think the also rans have been shooed from the market, which
Yep.
I'm fine with.
Right.
And so we wanted people to know we were investing. And to your point about deal flow, it was changing. And so we put out kind of a PR initiative to let the LA community know that we're still investing, we're still looking for people. And to be honest, we even liked to and found people that might have been laid off in an unfortunate, COVID related situation,
Mhm.
who were ready to start something, who had time, and our funding could help them support themselves while they coded for the next 12 months. And so we
Right.
funded 3 early technical teams out of that program in the month of May and June.
If you look at the aggregate data, I think we recently saw the early stage activity and dollars have dropped by about, I think it was about 25% to a third. Is that what you're seeing at the early stage?
Yeah, I think there is a narrative in the market, which is certainly true, but it's the loudest, which is these growth deals are getting crazy valuations. Everyone's topping up on money, going public in SPACs and the like. If you've got traction, if you've got tailwinds, if you've got a best in class product, these are good times. And we have some of our earlier investments that are now larger that are seeing that. But at the earliest stage, the late angels have disappeared from the market. Some of the funds that thought they would raise new funds haven't. And so there's less money in the market. It means there's more power and pricing for people like myself that have funds ready to go. And there's, more importantly, like I said, there's less people starting companies. I think if you've got that good job at Google, you're going to take an extra 33% thinking, should I leave now to start something, or should I maybe hunker down for a
Right.
year or two? So I think that's all leading to what you're seeing in the numbers.
So if you look at the LA market, there's obviously many variables that make up a good venture ecosystem. You talked about funding, you have talent, you have cost of living, all that kind of stuff. Like, what's the picture for LA in terms of the strengths and where's the biggest weakness?
Yeah, listen, we have had these growing amount of amazing companies here. GoodRx just went public. It's worth $20 billion. Honey sold. There's huge exits. Snapchat's here. And by the way, Facebook, Google, and Amazon all have over 1,000-person offices, and Netflix in
Mhm.
LA. But at the end of the day, the huge, massive campuses of enterprise software engineers that exist in Silicon Valley, and I'd argue nowhere else in the US, aren't here. And so there's just a certain maximum level of flow of talent and engineering that happens there that we still need to catch up on. I would argue that we have more than anywhere else, more than New York, that livability and proximity to the Bay Area helps LA in that regard. And most importantly, it's recruitable. I recruited people from San Francisco all the time. It's a great pitch to come move to LA. And I think we're seeing more and more of that. Continuing to build great, large, scaling companies here in LA that throw off angel investors and founders and really make our mark as our own technology scene. Although I hope we don't lose our differences from the Bay Area, which is different industries. Obviously, media is here, but there's just a lot of other industry across this 10 million person county that makes us different from the Bay Area and a great kind of place to live and diversity of thought and founders that I also don't want to lose.
So shifting gears a little bit, one of your first jobs was working in William Morris Agency's mailroom. What was that like, and how do you think that shaped you into who you are today, both in general and also as an investor?
Yeah, it was a crazy time. I was in the mailroom, literally pushing a cart around out of college with my ill-fitting suit, delivering mail to these agents that rep the most famous people in the world. And then I was an assistant answering phones and managing a calendar and listening in on phone calls. It was a lot of learning. There was definitely, it was pre-Me Too. So I definitely saw some bad behavior and things that made me move to tech because I thought Hollywood was not a fit for me. But some of the good things I learned was what they call client servicing. And I think venture capital has a lot of that as well, which is I think of my founders like the clients that an agent would service. And so it's my job to build a network, to ask them what they need, to help them. The more their career improves, the more the 10% agent fee improves or the 10% VC ownership improves.
Right.
And so that idea of kind of building networks, creating network effects within the portfolio and servicing your founders, actually, I owe some of the things I learned from my days in William Morris to that experience.
Yeah, no, it's always interesting. I mean, people say that your first and second job right out of college definitely shapes your worldview and your perspective on things. I know for me, same thing holds true. And that's a really interesting background that you have too.
Yeah, and it was also the serendipity that led me to this out of nowhere, actually, but due to some forethought by a gentleman named Paul Perico, who was an agent there and now runs an accelerator in LA called Amplify, to start a venture fund. And I was lucky enough to get hired into venture when most people didn't know what venture was in LA.
Is there a company that maybe you can use as an example and take us through the story of what did you see in the founder and where is it now? What's the big idea, just to get a feel for your type of investing?
Yeah, certainly. I think maybe an easy one here is a company called Clutter, which I think we can say is a co-investment with Proof and one of LA's most exciting companies. Clutter is a business that has rethought the self-storage model. Instead of doing it all yourself and putting everything in a locker with a lock on it, they come to you, they pick everything up, they digitize it, you can order individual items back at any time, and they provide all this service for equal or less than the cost of doing it all yourself. So really turn the model on its head the way UberX did in the car industry. And that was a business that had gone through pivots in LA. I knew one of the co-founders and now CEO, Ari Mir, through my days as a founder in LA. So my day one founder DNA here in LA allowed me to know who were the people who were the best founders in LA and would start the greatest companies and had huge vision. And so my relationship with him gave me that early deal flow insight. And as the company pivoted into just a slight change in their business, I was spending time with them at a friendly level, helping them think about execution. And I watched the business triple and then 5x across 3 months. And it was that kind of early traction that I was fortunate enough to jump in and quickly invest. There was an angel round before me and I was in a pre-seed round right after that. And from there, that traction continued. And within a year, they had raised the seed round and a Series A from Sequoia. But as a result of what we do, it's a company I've stayed very close to, obviously, given the relationship with the founder. That founder, Ari Mir, is now an LP in my fund. I have brought other executive team members of Clutter as LPs. I have brought them as angel investors and advisors to some of my other investments. And it's a company now that employs hundreds of people and has begun to create network effects in the broader LA community, and certainly that network effects and value to Wonder Ventures. So it's something we're obviously very proud of what they've built over there.
Obviously, we know the company because, as you mentioned, we're also investors. But talk about to the audience a little bit about how do they do that? Because it's even when we started looking at it, I'm like, how can they make it?
Product story, not the investor story.
The product, yeah. Like how do they make it cheaper?
The key innovation is self-storage is taking a bunch of stuff you don't use but want to keep and putting it somewhere and not touching it for a year, let's say. So the idea that you need this to be really close to your house was always the initial pitch, right? The public storage down the street on the highway, because I had to move it myself. I had to rent a truck and move it with my friends. And there, as a result, the closer to you the storage facility was, the more expensive the underlying real estate, the rent you'd have to pay. What Clutter realized is if we rent a giant warehouse way out in the desert, 2 hours outside of LA, that rent is literally 10x or less cheaper. And we can much more efficiently store all those items rather than commoditized boxes. We can actually charge you per square foot and be a much more flexible pricing. And the way we'll solve for that distance is, let's take the table stakes of moving it yourself off the table. We'll move it for you. Turns out the thing that allows them to have cheaper rent is actually also a service. So it's a cheaper service and a more convenient service. Combining those two things together makes for my favorite businesses. We see, again, the UberX, right? It's not only easier than a cab, but it's cheaper than a cab. It's pretty hard to beat those type of business models. And Clutter has now done this in 10 plus cities around the country. They've actually begun to acquire other existing storage businesses. So actually taking the real estate assets that are sitting around at full capacity and saying, if someone walks in and we're full, we can just offer them one of our other services because we have the trucks, and they're actually creating more revenue out of existing assets that have never been feasible before. And so building on that business into enterprise and other areas where they're expanding, they've now got this kind of logistics and moving and storage business around the country that we're really excited about.
And so out of curiosity, have you ever written a check on the spot?
On the spot. I've never written a check on the spot, and I try very hard to maintain what I would say is they'll give me a day to think about this.
Mm-hmm.
And by the way, when I offer term sheets, I tell them, don't sign it, take a day to think about
Right.
it. But I've certainly met a founder and been very excited very quickly and said, I'm very interested. I will confirm it tomorrow. Don't do anything without calling me.
Right.
Try to imply everything. I think there's a value to that founder of me. I think I would question someone who committed on the spot to me. I want that to be a mutual respect of thoughtfulness and how I invest. But it's definitely so early, and there's a lot of gut feel here, and I'm not afraid to use that either. So.
Yeah, no, that makes sense. And before Wonder Ventures, you were also a VC at the Mailroom Fund. And so in all of your years of investing thus far, is there a particular pitch that has really stood out to you?
I think the best ones are the ones that are relationships over time. My favorite investments tend to be ideas and conversations that become investments 3 months later. Those often include founders that are domain experts that can find their way. Examples include companies like Arcadia, which we've invested in together. Kieran, the founder there, was an expert in renewable energy, and we spent months talking about how to build a consumer business. And 7 years later, almost now, he's built one of the largest in the space.
So how did you come up with the name Wonder Ventures?
Yeah, that's an important part of the fund that I didn't mention, which is my wife is a creative director in advertising and branding. She works with some of the biggest brands in the world, like Google and others. And fortunately, she's also the chief creative officer of Wonder Ventures. And so all the copy, the name, I really owe a debt to her. And she's an important part of everything we do at Wonder Ventures. It's just a great name we're really excited by. We got a copyright and trademark on 6 years ago. And it allows us to build into any direction we want to go as we think about this platform. I've been very happy to have such a great name.
In the end, we ask some standard questions of all our guests, and we think it's fun and a way for us to get to know you a little better personally. So the first is, if you could have a magic wand and change or improve something about the VC industry, what would it be and why?
The thing that comes to mind here is it really needs a magic wand because it's a real rethinking. One of the realities of the VC industry is that a lot of investments get made early. You have to choose who to invest in you. And I think this is where a lot of what I do at Wonder Ventures comes from, having been a founder. You choose who you let invest in you, and then you're in a relationship for 10 years. And it's really hard to know who's going to actually deliver as an investor and be a good partner over those 10 years. It creates a lot of what we see now, which is the hype in VC. A lot of people using social media and other places to build their brands and then get into deals because of hype. Aligning the founder and the investor long-term value add so that everyone's happier with the relationship over the long term. And the people that aren't good over the long term, hopefully don't get more access in the future.
That's a good point. And it also actually brings up a question I meant to ask, and you reminding me, which is that if you invest at the super seed early stage, the companies are staying private longer than ever. And so it could be over 10 years. And the average fund out there now is open for something like 16, 17 years. So how has that affected you and your business? And how do you think about that when you invest so early that sometimes you won't have results to go and raise your next fund because the LPs are going to say, hey, show me what have you done kind of thing. So how do you think about that?
Well, I'm 6 years in. I don't know what I don't know yet. And fortunately, we've had some outcomes. Honey was 5 years in and returned our fund one. So that was lucky and very helpful in raising future funds. But part of the pre-seed pitch to my LPs and very much in my strategy is because we come in earlier, we have more optionality as far as returning the fund. So we could consider secondaries much sooner than a traditional massive Series A fund and still be returning multiples. I know of another pre-seed fund that sold a big piece of a position in a $1 billion or $2 billion unicorn valuation to return 3x its fund. And we can do things like that at much earlier stages. We can also have businesses that another VC may say, I don't know if this company ever goes public. It might only get bought for a couple $100 million. I can make a lot of money in multiples on my fund in those deals. But with that said, I tell every LP, don't expect to see money for a long time. We're very early. And we're also seeing shifts in public with these SPACs. So who knows if that's going to actually reverse as far as things.
It's great to see these innovations like SPACs that accelerate exits or even the secondary market, because that's one of the challenges that early stage VCs face for sure. Okay, second question is, if you were not a VC investor and money was not a concern, what career would you have?
Listen, there's like the dream careers, like a professional golfer or maybe a paleontologist discovering dinosaur bones. But honestly, I had my first kid a little over a year ago, and I'm totally cool with being just a dad and being at home and enjoying that life. And hopefully in my future, one day, I might get to focus on that with all my time. And I think that's the right answer for me right now, just being a dad.
Great. Third question is, who is someone you look up to and why?
Who's someone I look up to and why? That's a big question. Obviously, I have a lot of mentors and people I've worked for and my parents that have done so much for me. But I'm going to flip it on its head a little bit, just say someone I really respect right now, which is LeBron James. My wife's from Cleveland, and obviously we live in LA. But I think a lot of people might not quite realize how much he does outside of basketball. To be as good and dedicated as he is at a sport, still be at the top of his sport, but be creating massive schools, foundations, voting efforts, be a great dad, and really thoughtful about how he approaches his broader career and how smart he is in very traditional senses and non-traditional senses. I think the guy's doing as much for the country as anyone, honestly, and using his platform in that way. So a lot of respect for LeBron.
Great. And the fourth question is, what is the best piece of advice you've ever received?
Again, I think I'm going to answer slight variant, which is one of my favorite quotes, which I often give as a piece of advice. It certainly was mentioned to me originally as a piece of advice. I believe it's a Bill Gates quote that says, people always overestimate what they can achieve in 1 year and underestimate what they can achieve in 10 years. And it's very easy. I was saying this to actually our summer intern as we wrapped up her internship recently, that you look 1 year and you're like, if I haven't done anything in the last year, especially being stuck inside with COVID and a pandemic. But if you think about where you were 10 years ago, I was just out of my first job and certainly not married and a kid and didn't start a fund and couldn't imagine even starting a fund. And so giving yourself enough horizon to realize how much progress you can make in 10 years and not overjudging yourself on 1 year at a time, but just continually moving forward. I think you'll accomplish things and look back and really feel good if you give yourself 10 years to realize what you can do.
Dustin, thank you so much again for taking the time. It was great to learn more about your background and perspective as an investor, and also a little bit more about Wonder Ventures. We really appreciated it. We look forward to doing it again, hopefully sometime soon.
Thank you very much, and always a pleasure talking and working with you at Proof.
And follow us on Twitter at ProofVC or on our website at proof.vc.